a lot of the stuff happening in AI and just generally in software businesses, especially, you can build a business for so much less. The early stage has been really exciting. They're getting to profitability very quickly and in different ways, which is exciting, but also scary for people in our seat allocating capital. Us as humans think about debt and you think scary, you think bad, but if you peel it back, it comes in a few different forms. The most common one is a term loan.
What are some of the different types of capital that a founder can raise?
Debt financing is one, venture debt. There's a lot of other types of capital as well, whether it's like revenue-based approaches or, some of the platforms of the world.
When and why should founders think about raising venture debt?
Like, think of every month of time you have an extended runway, what it does to your valuation. If you can get 6 more months, 12 more months, that debt can provide that in a very cheap way.
Behind the scenes, it was a small group of people that were doing everything.
Welcome back to the GTM podcast. It's your host, Scott Barker.
I want to know how this insane growth actually happened.
One thing we've learned in helping our founders and operators scale their businesses is that cash is one of their most precious resources. Cash flow is really the lifeblood of any business. That's why we partnered with Flex to help companies improve the way they manage their cash flow. Flex is a finance super app built around a credit card with a unique net 60-day term that enables businesses to make an investment today and pay it back 60 days later with 0% interest. If your business growth is constrained by the cash flow you need for inventory, marketing, advertising, or really anything else, Flex could provide you with a really interesting growth lever. We use it here internally at GTM Fund. For more information and to apply now, visit www.flex.one. That's www.flex.one. Hello and welcome back to the GTM podcast. As always, appreciate you rocking with us and appreciate you all sharing this around. It's been pretty cool to see listenership continue to grow, especially over the last couple weeks. We had some heater guests, so thank you all. I'm glad you're not totally sick of my voice just yet. I know I am. I lucky to have other people edit this now because before I was going a little bit crazy, but excited for this one. We always have great guests, and this week is no exception. I am joined by my man, Nick Dolik. Nick, welcome, man.
Hey, thanks for having me, Scott. Good to hang, man.
Pumped to have you. Good to hang, man. Good to spend the next 45 minutes or so together. Quick bio on Nick for the listeners. So this one's going to be a little bit different. So a lot of times we have go-to-market operators. Sometimes we have founders. And then we have folks, from the VC landscape as well. Obviously, it's a big piece of the puzzle that you need to know whether you're operating inside of a tech company or you are building one. And so Nick is currently the managing director at TriplePoint Capital. He's out of New York, and he's really focused on supporting founders and funding high growth tech companies. Nick is just super passionate guy, loves entrepreneurship, and has spent really the last decade backing various startups, including multiple unicorns. So hell of a track record there. Can you name drop a couple companies?
I can, yeah. I have some fun ones that I can hopefully talk more about in the next few months. But I think the one that luckily is one of the first deals I ended up doing was Electric AI in New York.
Hell yeah.
Unicorn company here. You've probably come across the GTM radar at some point. Yeah, great crew. Ryan Denning, he runs it. He's a CRO entrepreneur. Couldn't be a better guy, couldn't be a better operator. So this business is kind of like, you don't have to feel lucky you're good for a long time, and feel very lucky in that one. So
yeah, I love that. And that was like the early days, one of your first ones?
I think it was my maybe second, third investment, almost a decade ago. So yeah, so, got the bug ever since, but I hope they all could be like that. But we know this business, it's, you never know. And it's been a fun ride there.
You think beginner's luck holds true in venture and investing? I've heard people sort of talk about it in the way that, when they started investing, they kept it super simple and they were like, bet on the human, get to know them intimately. And then, over the years, you create all these systems and you try and like over systematize everything, and you're looking deep in the nitty gritty metrics of everything. And then a lot of people say, and those were my shittiest investments. So then when I went back to just like finding the greatest weapons of all time and giving them money, then I became better again. You think that's a thing?
I don't know. It's so funny because my first investment I thought was going to be the best one. It had a pseudo liquidity event where they didn't distribute capital. And then we ended up getting our face ripped off. Like, and then the next one was an electric and fall. Like, I think it's consistent efforts. And it is funny though, you hear the stories of people who are like, pretty long time successful VCs, and they're like, yeah, my first deal went really well. And like, that is what got me hooked. And then I just kept kind of going. But you also have people who are like, my first deal, second deal, third deal, fourth deal, all went poorly. And I had a ton of imposter syndrome. And I was wondering if I was even going to make it in this. And there's probably a ton of people who we don't hear about it because they just didn't persist. And it's a hard business if you're having just L after L. But you hear about a lot of them that kept going, and their next deal was like a YouTube or a Square or whatever else. I forgot which partner it was, but one of the partners at like a benchmark Sequoia, very old school VC, had talked about that. I hear about it all the time. I've had a lot of those moments. I'm still only like a decade into this business, but hope to be doing it for many more decades. And I think those feelings are really normal for a lot of investors of that doubt. And you really don't know which ones are going to be the best ones. The ones you think are the best up front when you do the deal, obviously you think all of them are. But some of the ones where you doubt and you think there might not be an outcome end up being the better outcomes. So it makes the business fun. It keeps you humble. And, I don't know. I think the beginner's luck thing is interesting, but I think luck is a formula of just consistent hard work. And, I'll let you know 10 years from now, but
We'll do a follow-up pod in 10 years to see how it all turned out. It's funny, man. Listening to you speak, I don't know if I've ever told you this, but you look and sound so similar to one of my good buddies growing up, a guy named Tommy Knowles. Shout out to Tommy, who will absolutely never listen to this podcast. He's like a firefighter, could care less about tech or venture. But it's so funny, man. And I have a feeling maybe that's why we hit it off right away. I immediately felt like I knew you. And for the record, Tommy is one of the best guys I know. So you're in good air.
I think it's funny. We talked about this, I think, when we first met, and then obviously we've spent a lot of time together since. But you kind of know, regardless of if you can work with someone either directly or indirectly or now or in the future, like it's a funny thing in what we do. Like you meet so many people and you can get a very quick read on how genuine they are, like how passionate they are about what they're doing. And just as a person, like I think I love talking about this book that kind of shifted the paradigm for me, Give and Take by Adam Grant, kind of just understanding what a person's MO is of like giver, taker, or matcher, which is kind of like an exchange based, more transactional approach. And people just click, and it's a beautiful thing. Like it really is in this business. And there's ways that you can compound those relationships and work with each other for life. And I think that's key. Like, yes, you want to be known and it's an access game and meeting all these people and other investors and being like friendly in the sandbox in the venture business is, I think, like a norm people are really worried about and accustomed to. And I don't discount that, but I think there's something really important about working with people who you can work with for a very long time versus just trying to have very shallow relationships or like a one-time type thing here and there, just because the compound effects are so real. And what is inherently like a transactional business, you're making investments hoping they go well.
Yeah, I couldn't agree more, man. I think there's a Naval quote of like something along the lines of all great things in life, whether it's relationships, business, wealth, come from compound interest, and particularly in this game that we play. And I think it's such a hyper competitive game. And I think maybe in the early days, like the takers, it was more of like a taker game or like a hold your cards close to your chest game. It was like if you have access, you have it and you don't share it. And now I think it's shifting more to like the give first mentality can really, really make you stand out. And I think that's what I appreciate about you. And yeah, man, like just on that note, and not to get all mushy, but I do want to just publicly thank you. Of course, there's specific things we can't get into due to SEC regulations in our world, so we'll keep it high level. But I think anyone who has ever raised a fund or raised a round will appreciate this fact that you never forget the people who believe in you early, before the metrics start stacking up, before the brand is fully built, before you become that big, like tier one firm, which we have plans to do. There's just a lot of investors and LPs who will wait, and they're trying to de-risk their investment, which is super funny because by the time you're completely de-risked, you don't actually need the capital, you know? And, but we met, you were a straight shooter from day one, we covered a lot of ground. You invited me into your office in New York. You did the work, built conviction, went to bat for us, in the early days of you joining a new firm. And I mean it when I say I'll remember that shit forever, and I'll be working for the next decade to make our partnership the best decision you ever made, man. So if anyone is looking for a partner with high conviction, high integrity, high output investor who is also just a really good human, Nick is your fucking guy for sure.
I appreciate that, man. Yeah, I take this stuff really seriously. Like my parents are both entrepreneurs. I come from a scrappy Armenian family. Like I know how hard it is to be a builder and founder, not from firsthand experience, from supporting with everything I have other founders, including builders of venture firms like you guys. So I want to be a partner to GPs and venture firms who are building a business in themselves and their portfolio companies. And like, it's a long game for me. It's a craft that I'm obsessed with, and I'm glad you saw that pretty quickly.
Hell yeah, man. Well, I didn't mean to derail us. I do want to pick your brain on a ton of stuff. So let's dive right into it, man. Let's start with just the current financing environment and how you're seeing it for startups right now. What's kind of the state of the union in your eyes?
Yeah, I think it's been really interesting, and I think it depends on what stage of company, but the early stage has been really exciting, and I think remained pretty strong at the end of last year and even in Q1, just given a lot of people are creeping down with a lot of the stuff happening in AI and just generally in software businesses, especially. You can build a business for so much less. And I think that's been continuing to happen over the years from when AWS and other things happened, but even more so now. Like you're seeing all of these companies standing up really exciting things, and their reliance on that series A, B, C, or D, there's some worry, and some of it, I mean, I'm seeing in my portfolio, you're seeing in your portfolio, I'm sure, of they're getting to profitability very quickly and in different ways, which is exciting, but also scary for people in our seat allocating capital. So there's a lot of creep down, and I feel like early stage has been really healthy. I think the growth stage and late stage, given the valuation reset after 21, there are some companies that rightfully so and good for the founders. Like they raised at, some of them might have raised at valuations they shouldn't have. Some of them saw an opportunity to extend runway for many, many years so they could raise capital in a way that they wouldn't dilute themselves very much and just put their heads down and build and provide value to their customers. And they still have a lot of cash, but that cash is going to start running out, this year, next year. And there's a dynamic there of like, depending on where you raise and what multiple and what makes sense to make it an up round or even a flat round or even somewhat near the last round, you need to do something. And that's been, for me, who does hybrid investing with a core focus on debt, but also some equity, there's been that growth and late stage gap that still remains between investor and founder, where I think it's been busier for the less dilutive capital to kind of step in and provide that optionality or just runway extension for a couple more years to grow into a valuation. This year does feel, and I don't know, I'd be curious your thoughts. Like it does feel like things are shifting a bit, and the 22, 23, there were some dark moments there, and a lot of companies are still trying to figure it out. But I try to remain optimistic. I think there's signals in the market now that can objectively show some optimism, but I don't think we're fully out of the woods. It'll be interesting what the Fed does and just how things shake out.
Yeah. Yeah. We're definitely not out of the woods, but it does feel like we're trending in the right direction, particularly where we play. Like pre-seed and seed is super hot right now, as you outlined. It is more competitive than ever. I think I wouldn't want, like, I just feel so fortunate that we have such like a unique differentiator as a fund. Because if you just like went out and raised and you're just capital, like it's tough to compete to win allocation. And I at the same time, there's more and more in the early rounds getting left for like strategics, so like bigger, like more angels and more operators and like people that can actually like meaningfully help beyond just the capital provided. But yeah, and then on the growth stage, man, that's going to be interesting. I hope it comes back soon. Like I can count on one hand the amount of like Series C's and D's like I've seen. They're just kind of not happening, but they will have to happen. The reckoning is coming. And I don't know. We all get. I'm sure you get them too. Like these secondary purchasers, like emailing for various things, and there's some big companies that are hot companies that the price that they're asking is like a 70-80% haircut from where it was, which is insane. And so like even if it's 25% up from that, like that, some of these rounds will be not just down rounds, but maybe scarily big down rounds.
I think we'll probably touch on this more later, but I really believe that some of those growth and late stage investors, if they are the top tier investors that have capital to deploy, they have already provided capital to the companies that need it or that might be thinking about, hey, let's kick something out, let's do a convert, let's do what we can. So you're not the ones you're getting in your inbox are probably ones that their insiders should have been supporting, or you would think they would. So there is some asymmetry there of like, what is happening in that front and like how supportive for us on the debt side. At least you have to look at a lot of what you're underwriting, especially in the early stages. You're partnering very closely with the equity sponsors and like their relationships there. And similar to your point of like, you can't just have a bunch of money and put your hand up and say, I want to do this. Like you need to, there's a relational aspect of the business, not only to like find, pick and win as an investor, but also like just to be in the conversation because you have to be approved by the board and you have to be known as a good steward. But finding the businesses, I think, is continuing to be the name of the game in this market where there's less founders who want to give up 20% of the business every time they raise capital when they're at scale. So if they don't need to do that, or if they have supportive insiders, or if they have a pretty clear sight to just going to one firm or two, like you're just not going to see it unless you're really deeply ingrained in this and like you live and breathe it like we all do. It's really becoming an interesting game with, I mean, there's a lot of capital out there still. I know it feels really tight for a lot of founders now, but there are so many firms now and there are so many smart people and other ways to capitalize a business. Like, and I don't think that's going away. I think it's going to get more competitive and it's going to create a proximity effect. It's going to create a lot of relational aspects that like you need to have. And to your point, you guys are really well positioned because you provide something much different than just capital before you invest, after you invest, all the way through. And like, I think that's not like a nice to have in this market, in the future market. To me, that's like a necessity. So I think it's going to be interesting to see how firms try to differentiate if they're not like the long-standing top tier firms that they differentiate by a brand and by their expertise. So yeah, I'm closely watching and we're obviously living through a lot of it as well.
Yeah, I think we're going to see like over time almost this like barbell appear where, yeah, of course the big brand names will not be going anywhere, but that's kind of what they give is the brand and future proofing, future fundraising, deep pockets. And then like a lot of these folks in the middle are going to get out competed. And then on the other end, you're going to have these like hyper strategic firms that maybe they're experts in product, they're experts in AI, they're experts in GTM, whatever it is. And, that's how you're going to make up kind of a cap table of the future. But so I want to talk to you about kind of the different types of capital. Not all capital is created equal. And I think in startup land, we've gotten drunk on the idea of like traditional venture is the only route to like go if you want to build a successful company, but there's tons of different types of capital out there. What are some of the different types of capital that a founder can raise?
Yeah, I always have an extreme bias here, but I can talk about it more. But debt financing is one, venture debt. There's a lot of other types of capital as well, whether it's like revenue-based approaches or like, some of the platforms of the world, like the Clear Codes, the Cap Chases, like the Square Capital is the Shopify Capital. It's like for just a bunch of type of businesses that maybe need something very lightweight. But specific to this conversation, and like when you think of raising equity from VCs or raising alternative financing from more core venture debt players like a bank or a debt fund or a hybrid fund, there's a growing universe of that now, especially post SVB, where a lot of really smart people, obviously, my background before joining TriplePoint was opening and running the New York office for Signature Bank's venture arm that we all stood up. And now that Signature went under, First Republic went under, SVB, obviously, a lot of those people went to different places and they've been in this business for a long time. And now there's multiple banks, multiple venture debt players, multiple really smart people who can provide less dilutive capital to these companies. So I think it's a great thing for founders. I think it's a great thing for equity investors who want to preserve dilution, or maybe don't have reserves, or maybe it's past the stage they invest. Maybe they even want to invest, and there's other types of capital that someone like me or others on the debt side can provide that just makes more sense for the founder and makes more sense for the business. Like, you can think of the obvious ones, like if it's a hardware business and things like that, but even for a very capital efficient software business, there are things that you can look at on the debt side that can very much complement your equity. It can very much replace equity in certain cases, because the predictability of your revenues and the predictability of your net new and what you have to do to get that, and cash LTV and all these really beautiful, predictable metrics of a SaaS business fit very, very well with debt and the interest payments you'll have and those types of calculations you need to be thinking about as you support the debt. And in reality, most of the time, this debt is paid back in future fundraising rounds or upon liquidity events. So you're not really riding these things out to maturity and paying down all the principal until the end. Like, it's usually like you have a next round and then you pay it down and you do a new, bigger and better deal, ideally with your partner who can scale with you. Like, I do this from seed through IPO. So I try to be a long-term partner. I've been enamored with this hybrid approach for a long time. And TriplePoint has kind of pioneered that over the last almost 20 years. So we are mostly known as a debt financing partner to startups from that stage all the way through going public. $1 to $100 million checks, but we also write equity checks if it makes sense. So what I want to do is really just be that capital partner that can help a company at any time within equity rounds, alongside equity rounds. I can work with the equity sponsors themselves too really closely. And that's a core part of our business, is like working with VCs like you guys who really believe in this approach. And I think more founders are kind of waking up to it, given there's just so much more exposure now, where it was kind of like when I got into this business, it was kind of like SVB and there were a few others and it fell off a cliff. And that's kind of what excited me about getting this business when I was on the equity side and at a startup before that. But it's still like, when you look at, if you're raising a series A, B, or C, there's probably hundreds of firms you can look at on a list just in, New York SF. I mean, I know there is. If you look at debt, there's like 10, 20 total at every state, like real true players dedicated to this craft of financing startups. So I do believe it's like there are a lot of options and we're seeing it, but I think it's just scratching the surface. I think there's so much room in this business. It's still very much an opportunity, and I'm really excited to be someone attacking that opportunity.
I love the hybrid approach that you take. But I want to take a step back and just stated the union a bit. I feel like I'm using that phrase too much, but demystify venture debt. And I'm just going to play completely dumb here. We might have a lot of listeners who don't even know what that is. So what is venture debt? How does it work? And why does it exist?
Yeah. Okay. I will keep it very simple, but I'm glad you brought it up, because I think us as humans think about debt and you think scary, you think bad.
Negative connotations right away. I got on my credit card bill.
Like,
Fuck.
yeah, what if we got you on this? And like, but if you peel it back, like what we do, and I'll keep this focused on like venture debt financing dedicated to venture backed startups. So it comes in a few different forms. The most common one is a term loan. So you would think of a certain amount of capital that is provided and available upfront. You usually don't have to draw this capital. So think of a Series A company. What we provide is usually pure option value for them. So if you raise a Series A debt provider will probably think about it we'll come in and give you a certain percentage of the fresh equity. Say it's up to 20, 30, 40%. Raise 10 million bucks, maybe we come in and look at 2 to 4 million. That capital is minimally dilutive. Like, because the further on the risk curve the lender is, the more warrant they might need. But because you're a Series A company, they're probably going to need 50 bips or less of the cap table total. So if you're thinking maybe you raise it at 50 post, giving up 20% of the company on that 10 million, you're getting another 2 to 4 million for less than 1% of the business, but you're getting almost 50% more capital that you don't even need to use. And it's pure call option to extend your runway. You could use it for acquisition financing. You could use it for extra growth and working capital. It's something where, like, if you want to raise, say, 15 of equity instead of 10 in that round, you're committing to that. And you're taking out the dilution up front. Whereas debt is something that for a company in A can be pure option value. I think that's like a core use case for companies. It's extending runway if they need it, insurance policy. But I think what's been really interesting for SaaS companies, but also like a more scaled business that maybe B, C, D onward, debt can become a really useful tool for similar reasons to extend runway, but really for, acquisition financing if you're seeing competitors hit the wall, or bigger swings on the growth and working capital side that aren't an equity use case, or maybe are an equity use case, but you just don't want to take that dilution. Or maybe it's getting you to break even profitability, and then you can really control your own destiny around, do I even need to raise equity again? I think that is something that I think equity investors and founders are really starting to utilize more, and it's created more business and more activity in my seat. But I do think there's still a lot of stigma around it of like, oh, but you're senior, you could take the company. Like, the reality of it is it's such a relational business. Like, in equity, if you're not leading rounds, like, you don't have to be one of one. Like, you can be part of the syndicate, you can be helpful. Whereas in debt, like, unless you're doing a senior junior deal with like bank debt funds, like, it is one of one. Like, you would need to be approved by not only having the founder want to work with you and pound the table to work with you, but the entire board needs to sign off it. So the equity investors need to know and like you. They need to know that you're a good steward, because sometimes there are financial covenants on these deals. I try not to have them, but if they're part of venture debt, it's covenants around maybe liquidity, maybe performance, maybe both. There's a lot of different types of ratios that sometimes, especially banks, have. If those are tripped, yes, like, theoretically, keys could be taken, other things could happen. And I think that's super scary for a founder. But you need to make sure, if you're doing this type of investment for your business, it's with a relational partner that has skin in the game above just your company. Like, yes, we have LPs, we have things we need to do, but if we're doing a deal with a founder or equity investors that we either do multiple deals with or want to be doing more with, or who are in, a lot with, like, they need to know that you are a good steward and you're in the boat with them, and you are rational, and you're not a knee-jerk partner that gets scared if COVID hits, or there's a downturn in the market and all these other things. And like, we've all been doing this a long time and have shown in ups and downs that we're good partners. And like, when I talk about compounding, like, that is compounding. You can't just have a ton of money and want to do venture debt as like a hedge fund or something and come and win a bunch of venture debt deals. It's not something that happens. And it's why this industry has stayed somewhat niche, even though it's growing, because it is such a nuanced underwrite and relational game. Like, you're lending to cash burning companies. To a lot of private credit people, that makes zero sense. But to us, it's like, it's what we know and do. And the losses in this asset class stretched out over many, many years. Like, you can look at public data from SVB or some of the other players out there, the public BDCs. It is crazy how resilient these businesses have been. And a lot of it is because there is this interesting underwrite approach and relational approach. And even in down markets, like it is why you see Blackstone and others talking about why it's like the golden era of private credit. It's a lot of it's like this confluence and tailwinds of bank and reg pullback, and then, companies waking up to the fact that you don't have to dilute yourself as much every time you need capital if you're the right type of business.
AI is creating endless opportunities for sellers and the SaaS industry, as 77% of companies are either using or currently exploring AI. Still, it can be overwhelming to understand where and how to implement it properly into your tech stack. That's why our friends at Aurum launched Bold Calling, their new podcast. Every episode features a prominent tech founder or sales leader, their daily challenges, and how they're using the latest technologies to solve them. Aurum's AI dialing solution maximizes the amount of conversation your sellers can have while cold calling. Sellers still devote up to 30 hours per week to admin tasks, and 78% of sales professionals agree that AI can help them spend more time on the most critical tasks. Anshul Gupta, co-founder of Actively.ai, shares a game-changing solution for reclaiming that time using AI on the very first episode of Bold Calling. And if you're curious how sales and marketing leaders are actually implementing AI tools, I would highly suggest checking out episode 2. They dive deep into it, and it's well worth the listen. Bold Calling from Aurum is available wherever you subscribe to your podcasts, and be sure to check out the episode show notes to download Aurum's State of AI in Sales Development report. Now on to the episode. Yeah. So what I wanted to just kind of underscore, we get a lot of founders listening to this, and they're like, okay, this is interesting. When and why should founders think about raising venture debt? You mentioned a few. There's like, you can maintain more equity. You can extend runway. You could potential capitalize on some acquisition targets. I think there's another interesting one that I've seen that makes complete sense. Is almost like bridge rounds have a really black eye in like traditional venture, but you can do kind of like some small bridge venture debt and then get all of your metrics to a place where you can actually raise a meaningful round at the valuation that you're hoping for. Is there any other avenues that folks look for?
I mean, I think the core one that just I need to it's something that I try to pound a drum on is if you are a high growth venture backed startup, think of the value just even based on like a conservative multiple. Say you're a typical SaaS company, you're growing nicely. Say you think you're going to get 5, 10, 15, 20 times revenue from a valuation perspective in your next round, and you're growing nicely. Like think of every month of time you have an extended runway, what it does to your valuation. If you can get 6 more months, 12 more months, 18 more months, that debt can provide that in a very cheap way, and it completely justifies itself. I know you can look at, well, I have to pay interest on the debt I use, and there could be warrants I have to give up. It's like if you actually stack the cost savings you get from utilizing this to extend the runway, it's actually mind blowing when you put it on an Excel sheet and you look at it and you think about it. But yeah, I think the main use cases are that it's optionality, but it is becoming something that for growth and working capital, something that is equity like in nature if it's from the right partner. Like I try to be an extremely flexible partner. It is an equity like relationship, but you are paying interest on the capital you use and it has a shorter duration. But if you think about preferred equity at the end of the day, like, yes, it might not have a maturity period on it. You might not have cash interest payments you need to do, but that's still a pref stack. Like that needs to be paid back at some point. And I think that's something that like a lot of people miss when they think about, oh, that I have to pay back. It's like, I know the equity feels really flexible and it's a huge, huge tool. And I'm a huge believer in it, and you need it. And it is a core part of the business for companies that are burning a lot of cash to invest in growth to get to an exit event, which inherently are most startups. But it's just something to think about and really be thoughtful around. And another, I've talked about it, but M&A in this market, like there are a lot of really great companies that maybe wanted to go the venture route and raise some rounds of venture, and they're realizing they have a great business, but there's no way out of this to be a multi-billion-dollar company and return a large fund of their investors. So they don't really have a home, but they have a great business. They're a great team. They might have IP, they have other things. And Like there's a lot of really good platform companies or just general companies that can be a great home for them. And we finance a lot of that. Um, it's something that is continuing to be a huge use case, but I think between that and extending runway and then just being cheaper working capital and growth capital is kind of like the best ways to think about this.
Yeah, they everyone was predicting this to be the big year of M&A. I don't think I've seen as much as I thought was going to happen. Maybe in H2 we'll see it more, but I'm with you. There's so many. I think of like the rev tech category in particular, like there's these big incumbents that have a decent amount of cash, and there's all these ankle biter like AI entrants that entered the race. They're like point solutions. They do it really cool. They're super innovative. They got to 1 to 3 million ARR. They raised some money, and then they realized, oh, we're gonna compete against these guys. Like we're a one use case thing, and they have all of this. And so if I was some of the bigger players, I'd be scooping up a bunch for, before they go raise more money, 6 million here, 8 million there, and, just infuse them in.
This is maybe getting too pie in the sky, but like what's more valuable than equity in your business? It's like the time as a founder who's probably extremely talented builder, like being very thoughtful. Is this what you want to be doing for a very long time? One, hopefully before you take on venture dollars, is this the route you want to take? But even when you have, like, there's a lot of companies sitting on a ton of cash still that might not even have product market fit because they took advantage of an opportunity at a point in time. And like, I think it's an important time for them and the board to think about, where is this going and does it make sense? And it's okay. Like, I think we'll dive into more like common misconceptions of founder VC or founder debt partner, founder capital partner broadly. But I think it has been an interesting moment as we come out of COVID and as markets kind of shift of like, where do you want to be spending your time as an extremely talented person who doesn't get the time back? So I've been having a lot of combos, just like very much real combos around that type of stuff with investors and founders. And I think it's a really good thing.
Looking yourself in the mirror and be like, do I want to dedicate my life and all of the sacrifices that come with it for the next decade? And that's what you're doing. And I've had a front row seat of a lot of founders through my journey, and you sacrifice a lot. People see the outcomes and the big, IPO or ringing the bell or TechCrunch articles or secondary, but family life is tough, health struggles, everything.
There's so many lonely times for founders, and it's why I have so much respect and admiration, and like it makes me so grateful to do what we do. Like what we love doing doesn't exist without people being willing to take that risk and going through all those really hard things. Like I know that we can talk about, and some investors look, maybe I'm wrong and they are a reason that companies had certain large outcomes, but like I'm of the belief that the best founders don't really need me in the capital. Like they are the ones executing. I am hopefully there to be helping where I can and as much as I can along the way. But like it is a lonely journey for many founders and co-founders. Like it is a hard journey that even the best companies, like even the best founders who have had huge exits will probably have many, many stories of when they're like, it was over, this derailed my life event, or I didn't see, had young kids and had to miss certain things. And like, it's what creates what we love to do. And like, I'm just so appreciative of all that. It's really not easy. And I can't say it from firsthand experience because I haven't had to be in the weeds building one thing. I've been able to support a lot of awesome companies and work with great founders and see it and support them through it. But it's real. Like it's definitely not something to be underestimated.
Totally. Well, that's a good kind of segue into, I want to hear about your story, man. I know when we met, we bonded over a few things. One, playing high level sports growing up. I know you were a lacrosse guy, I was rugby, and then just having very non-traditional paths into this world. And, you did it the hard way, like the old fashioned way, through a shitload of grit and just betting on yourself again and again. How'd you get here, man? Like, break it down.
Yeah. I don't need to go way like too far back, but I mentioned my parents being entrepreneurs. That was kind of I was out of school. Like I played lacrosse at Penn State, grew up in Michigan, like surrounded in Michigan by a ton of entrepreneurs. Like we were in a hometown of, it was either like you worked in auto or it was like scrappy, mostly small business, like whether it's family business, whether it's they're just starting it, like putting it together. And then after Penn State, I, like a lot of my teammates, ended up in finance, ended up on Wall Street. Most of the time was like Goldman and credit. And it wasn't anywhere near the credit I'm doing today. It was like very much old school credit derivatives, and like it was a pretty slow industry. And I was kind of like, you're in that moment right out of school. You're like, okay, this is, I need to find what I really want to be doing. Like what am I excited about? And I knew for me that was entrepreneurship and startups, but I didn't really know how to get there from like credit derivatives at Goldman Sachs to, hey, I want to be working with startup founders and like help them wherever I can and hopefully start to invest. And, you know, like many people who are excited about what we do, it's like, oh, I'm just going to go try to work at a VC firm. And not really realizing that everyone who is extremely qualified is trying to do the same thing. And these firms are inundated with that, and not knowing that there's certain times within, fund cycles that I knew nothing. I just was like really eager. I was like willing to help and talk to anyone I could and just kind of roam around. And I had met a portfolio company of a firm, and, the recruiter there said something to me that was really eye opening, which was, Nick, you know, I don't discount your willingness to work hard, and I know you could do the job. And this is a recruiter for the VC firm. But I would really encourage you, you're young. I was like 23, 24. Go work at a startup or go work a service provider that serves startups and venture firms. Get to know both sides of the business, meet a bunch of really good people, work really hard, provide a lot of value. It'll get you in the game. Maybe take a crack at the investing stuff later. You'll figure it out, but like it might be worth taking that leap. So I did. Thankfully, I had the ability to make the jump and take the pay cut with it, do the whole thing, and ended up in Nomad Financial, where I ended up running growth for them. Nomad basically was the finance partner for startups, and we worked with venture firms as well. So we sold that business right before COVID to Nero. But what we would do is basically work closely with founders at the very early stage, like pre-seed, seed, A, like, okay, let's put together your deck. Let's put together your financials. Let's help with the model. Let's think about fundraising. Ideally, I can connect them to the VCs. And, through that experience, I saw opportunities to meet founders at I like to call it before like the Instagram version, which is when they're raising capital. I got to see little things like, how do they treat their team and my team? How do they answer emails? How responsive are they? How dedicated are they to this? And I had started, connecting founders to VCs that we work with, like good seed firms in the city, wherever it was. And I saw them investing. I was like, wait, why am I not trying? Like, I've seen these things. Like, why am I not trying to invest in these companies? And I was like, well, I was just like trying to squirrel away money where I could to try to get in the game. And my brother had been in startups, my older brother, for a while. We like to say he's like the rock and I'm the kite. And we both were like, how do we get involved? And this is before AngelList, SPVs, like all that stuff. And like, where you could basically get in these deals and raise money. It was like, okay, we need to just provide more value than, anyone who wants to invest in this. Because most of these rounds we wanted to get in were like, they were going to be super hot. And even if we had a first look, it's like when a lead comes in, that it's gone. And like, they don't want our 5K, 10K check. So we would just roll our sleeves up and do everything we could to help and just make it undeniable that these founders were like, I don't care. Like these guys are whatever their check is, whether it's $1,000, like they have been incredibly valuable before any of this. And like it's your model, but like baby side, like you guys do that in a real way. It was like, we're just, Nick running around the city trying to help founders. And I did that because I really had realized after a lot, like many years of being like, I want to get into VC, of these firms were going to hire me. And like, I needed to show with my own money that I could do this. And like, I didn't know if I could. And I'm still like, I'm a decade in, like, I hope I have many more decades ahead, and I'm still learning everything and I want to keep learning. But I was like, I need to prove that I can do this, not only to myself, but in the market. And the rest will figure itself out. So did that, thankfully, like early in some really great companies. People saw that traction. They wanted to get involved in those deals. I helped after we sold Nomad, I had helped a family office stand up their venture arm, good investments there. And through Nomad of like, we would also help with debt financing and debt partners and all that. I saw this underserved gap. And I've always been, since those moments, intrigued with how do you raise capital for a startup that isn't just equity? And I saw that opportunity and I really wanted to learn it at an institutional level. So that's how I met the team at Signature Bank. They had just built and sold Square One Bank to PacWest, really entrepreneurial group, and they needed someone to open and run New York. So that's where I went into that to learn venture lending at an institutional bank level from a regulated entity that was, Signature was like $100 billion bank, and they gave us basically runway to build a startup focused on funding and banking startups within it. And that's where I kind of got in this hybrid game, and that's what led me to TriplePoint. But yeah, it was kind of just a long-term will thing. I was like, I'm gonna figure this out, and it's kind of like coming from lacrosse in Michigan. Like, it's not a hotbed. You kind of just have to outwork, consistently do it, and try to smart work. And I just try to do that every day. And a lot of times, like, it's not gonna work out how you hoped it to, but you either, you kind of win, which means it happens, or you learn, which some people could call a failure. But if you just keep plugging away at it and you learn from the losses there, I feel like it's inevitable. You're going to figure it out. And, thankfully with a lot of this stuff over a long period of time, the work I did 10 years ago is benefiting me today. And hopefully the work I'm doing today will benefit me, 10 years ago and the people I work with. So yeah, it's kind of just like take a risk on yourself and hope it figures itself out. And so far it is, but I have a lot of work to do and a lot more to prove.
Man, it's a good story, and thank you for sharing. It's an inspiring one, and also good. Just a lot of good stuff in there for anyone looking to get into VC or even like startup land or any new thing where people won't give you a shot. Sometimes the best thing you can do is just go and do it, and bet on yourself. If they won't let you in the door, kick in the back window and let yourself in.
I talk about it as getting close to the sun. So for me, like, I wish I knew this going in, but like the Nomad role for me was close to the sun. For me was like the end all be all of the craft I'm obsessed with. I want to do for the rest of my life is investing in supporting founders. And like, yes, coming out of Goldman in a random structured credit role that had no application to doing that, was a hard sell to be like, oh, I want to get into VC. But me going to something closer to the sun of, hey, I might not be investing in startups today, but I'm working with great founders. I'm seeing how they build their businesses. I'm working with the investors. I'm supporting their portfolio. I'm understanding their business. Like, that got me a little bit closer to that sun. And then being at Signature, learning venture debt, wanting to be more in hybrid and investing in startups, like closer to the sun. At TriplePoint, I am doing the exact work that I'm a big believer in long term, which is hybrid investing in startups. And like, it's a process that looks methodical when you kind of roll it back. But at the time, like, I wasn't planning it in this way. I was like, oh, I'll get to Nomad, I'll get in the game, I'll be on a platform, I'll serve the people I want to be working with today. It's like, you don't see that, but it's so invaluable to see these different lenses. And like, I think it's why a lot of great investors were founders before or went to startups before. I don't think you need that because I think the change of businesses is so rapid that even the reps you had 10, 20 years ago as a builder might not be as relevant today, but the patterns of that are still relevant. And just having that empathy and understanding of being at the startup, it's invaluable. And like, Nomad was totally a startup, and like, there's a lot of really fun stories. It wasn't like the boomer bust venture type, but we worked with a lot of them and we really were scrappy. And that benefits me a ton today when I serve startups.
That question, how do I get closer to the sun, is a good one.
Yeah. Well, I don't know where that came from, but
Yeah, it's a good one. And now it's easier than ever too. Like, you know, if you're trying to break into, let's say, VC, like, you can start interviewing VCs. You could start a podcast. You could start a newsletter called like Junior VC. Hey, I'm just figuring it out. And you're just like sharing your learnings and go, if you don't have any money, like, go be a sweat equity angel and just be like, hey, I'm just going to help you. And I'm going to help you so much up front that maybe you'll want to make me an advisor or something, you know?
Yeah. And doing it genuinely in your heart, like not wanting anything in return is just the way.
Gotta love the game. You gotta love the game. That's what I love about you can hear your passion of like
Real the people who you want to be like impressing your work, like they meet so many young people who are eager and other things. Like they can sniff that out so quickly if you're just trying to like get something from someone, or like if you're just not genuine in the pursuit, like they'll probably challenge you like, hey, okay, maybe do this or send me this. And like 9 out of 10 are just never going to do it, and it'll just never happen. Whereas like a few will. And there's so much asymmetrical upside of just reaching out to somebody or offering to help with something unsolicited and being creative and being excited. And I had so many people helping me. I still have so many people helping me. Like if someone comes to me with I can tell it's like a genuine pursuit and thoughtful, like I want to help them. And most people want to help. Like I'm a huge believer of that. So I think it's just, you got to shoot your shot on certain things and like do it thoughtfully, but also like, you know, I think all of us are much more capable than we believe in. And you just got to shoot the shot. It's always a no if you don't ask.
Totally. All right. I want to go to a quick listener question here because it's a good one. And we actually get a lot of fundraising questions, and I don't always have the right guests to answer them, but I got a lot of thoughts. I'm very curious to hear your thoughts. The question is, I've never run a fundraising process before. We've been bootstrapped to date. We have good metrics. How should I approach my first fundraise?
Yeah, it's a good one. I think before even jumping into the fundraise, I think it's kind of the parts we talked about. Like, is this the route you want to go? Like, before you raise the capital, like you are choosing a binary outcome. Do you want to be on the venture hamster wheel, which is great? And if you are and you have the right metrics, go for it. If you aren't, I think it's a good inflection point of if you're bootstrapped and you could raise different types of capital and own all of the business or own most of it. That's something just to think about. I would approach it one, like it's a long game. If you can start to meet people, especially investors who you might want to partner with and all that before you're like the Instagram version, like, hey, here's my deck, I'm fundraising, let's meet. I think that's invaluable. And then it's really taking a step back and like being in their shoes of what are they going to want to see. If I'm a institutional venture fund, if I'm a large fund, like depending on your stage, it's like what I want to know as an investor. And I think what a lot of investors want to know is like, why this and why now? And it's like, you need a couple components. It's like, you don't really, I think of it like it's a surfing analogy. It's, I don't know where I picked this one up, but it really sticks for me. And when I look at underwriting opportunities, like it is, you need to be the right surfer. So it's like, is it the right founder for what they're trying to build? Are they on the right board? Is it like, doesn't matter if you're the best founder for what you're doing and all of that. If you don't have the right board you're on, whether it's your product, your market, whatever it is, it doesn't even matter if you could be the best operator, aka surfer in this analogy. And then it's like, are you riding that? Are you on the right wave? So you're the right surfer, you have the right board, are you on the right wave? Like you need all those things to even have a sniff at being like one of those large venture type billion, 10 billion large venture outcome that these investors need to have if you go the venture route. So I think it's really making sure you have those pieces and then demonstrating that, like clearly demonstrating that and being very real about it, I think is important. And I think it's just making sure you align with the right investors is so important. Like I know in fundraisers, it can seem like, oh, you're getting a ton of no's and it's really a slog. And I think there are so many, I mean, I don't have any stories in my head right now, but there are so many awesome companies that went to hundreds of investors and they all said no. And one or two or three or four, it's a funnel, it's a sales funnel. It's like a few took the meeting, a few were like, okay, I want to learn more. Then maybe like one said yes. And that was the difference of them just hanging it up or doing it. And now they're like massive companies. Like I think Airbnb was one of these.
Outreach was one. Man, he had literally hundreds of no's. He started going in person to every venture and he got like doors slammed on him and stuff. And a lot of those people came back in a couple of years. So
like the short answer of my ramble there was like, make sure it's the route you want to go, play the long game on it, and be persistent, like trust yourself. And if it's something you're like, I'm ready to dedicate the next 10, 20 plus years to this, like have that confidence and conviction and display that to investors. And there's gonna be a ton that just don't get it, or you caught them at the wrong time or whatever it is. But there will, if it is a compelling approach and you're the right surfer, you're gonna find the right people. It's just it takes persistence, and unfortunately, it's a lot of numbers.
Yeah, I would underscore that. And my first gut reaction is don't, don't, don't raise venture. Don't do it. I try and talk founders out of it all the time. You're bootstrapped right now. You have good metrics. You know, if you can keep going, why not? Just like it's just a totally different game, and you have to be very real with yourself if you want to get into that game. There is other, you know, we've obviously talked a lot about like venture debt. You could do a small friends family if you really need capital for some reason. You could go to banks. You can. There's so many things that don't force you into a path where it's kind of grow or die.
Yeah, like there are people who will give you half a turn of ARR, maybe one turn, maybe more, maybe less. It depends on your appetite. But I mean, if you're a $5-10 million ARR business, like you don't need to have that much in cash in order to have someone get comfortable in this universe. Like there's a lot of really interesting, more growth equity type lenders, less like venture debt, who want to see an institutional VC that is backed you with the C or the A to get involved. But I mean, there is a wide universe there, and especially with like even some of the banks have pulled back on like the net borrower type. There's so many different entities and vehicles that have popped up to serve these types of bootstrap founders that there's more founders taking that route. And it's obviously like for VCs like us, like there's less opportunities that want to take that path of like give up the 20%, go for it. And that's okay. Like there are some really great bootstrap companies that don't need to have the multi-billion-dollar outcome. They can own a lot of their business. They can get the 10, 20, 30 ARR, sell for a really nice multiple and do really, really well. Whereas like if you go the venture route, it's incredible. You can have large outcomes if you're in the right market and you execute, but like it's a much different path and it's not an easy one.
And I would urge everyone to go watch the Jensen Huang, CEO of NVIDIA, his interview he did where they asked if he would do it all over again, and arguably one of the, you know, hottest companies in the world right now. And he's like, no, I wouldn't. It was too hard.
It's interesting to see that. Like there's a lot of serial entrepreneurs that they're knowingly going into the next one, and like you gotta love that. But, like they know how hard it is and they're doing it. But it's also why I can appreciate, just being naive. Like it's kind of like when I was trying to do the venture stuff, like I had no idea how hard that slog would be to try to like navigate all this other stuff. But if I knew I would like to think I would still do it, just because I'd like to give myself a little benefit of the doubt, but probably not. I mean, when you know how hard some of these slogs are before you do them, it's a lot harder than if you have some of that. Like it's okay to be a little naive in these things, because like a lot of really great founders are just going to overanalyze something if they've done it before and be like, nah, it's too hard, I'm not going to do that. Whereas the first time founder, like they're just going to go for it. And like that's also a very beautiful thing.
For sure, there's a superpower there. Naivety can be. And then the last kind of piece of advice: if you do decide to go to the venture route, I do see a lot of founders make the mistake where they go and pitch their like tier one investors right away, the ones that they really want to invest. And like it's just like anything, your first pitches are going to suck, you know. So tier out like tier one, tier two, tier three, and start with your tier three ones, the ones that like you'd be happy with, but you wouldn't love them to be on the cap table, and like get some cycles in. Every pitch you do, you'll get better. So don't go straight to the ones that you want, because you got to learn different objections and get crisp.
Yeah. And you'll click. It's a long-term relationship. So just like, yes, if they want to invest, it's great. There's things, but like you really need to weigh, like, is this someone I want to spend time with for a very long time?
It's just like an interview, right? Like I think the best interviews you have for like jobs is you're interviewing them as well, right? And the power dynamic is more equal. But anyway, man, I got two more questions for you as we wrap up. We're running out of time here. First question is, what is one widely held belief that founders still believe to be true that you think is bullshit or no longer serving us?
I think the dynamic between founder and investor is very much like they only want I can't call them as that first call when things are going terribly, or I have doubt on this, or other aspects around like negative parts of the business. I think the first instinct for a founder, if it's someone on their board or a main investor, is like fear around that, because there's like a disappointment or an embarrassment or a gotcha type feeling that I think some founders can have. Whereas like the founders who have really good relationships with their equity investors, and it's like, I try to be this for companies. It's like, I want to be that first call, like 24/7, 365. Like, I want to be not only your investor in support of a business, like, yes, I have LPs and stakeholders, but like, I know that you are on a very hard journey. And I know that startups inherently, like, there are a ton of ups and downs, even for the best companies. And just generally, it's like a very volatile thing over the long term. So I think just this whole aspect of like, need to be all, super buttoned up with your investors. You can't have real conversations, and just really have those on a, whether it's a normal cadence or just know that that exists, is something that it like really frustrates me when, things could have been avoided over a long time. And, you know, maybe that conversation that you wish you had could have changed it all. I think it happened way too much.
I think that's a great call out. I mean, startups, you have the good, the bad, and the ugly, and sometimes the bad and the ugly is kind of hidden away from investors. But if you share that, like, we want that. That's like, I almost want that more than the good news, because like then we can get ahead of it, and there might be a world where we've seen a similar situation, and you're sitting there, staying up late at night for weeks when there's a quick solution that we could help you with.
I mean, a lot of us have worked with many, many companies, and it's like those patterns and reps are real. And it's like, it's just, um, yeah, I wish that was something that happened more, but I do think like the dynamic of founder investor, I think still needs to change. Like, me as an investor, I'm here to serve founders and the companies they're building, and hopefully be maybe a large, hopefully some part of that story, small, large, whatever it is. Um, it's not the other way around. Like, we need founders. Without founders, we don't have a business. And like, I think that sometimes gets blurred, and I hope it changes.
Yeah. I think it's going in the right direction. But yeah, still work to be done. All right, my man, this has been awesome. Final question for you. We got a lot of operators, a lot of people running sales teams deep in the sales or marketing realm. Fundraising is very, very similar to enterprise sales. It's like maybe the purest form of sales in the world, because you're selling yourself and your strategy, and it's super relationship heavy. What is one tactic or strategy that's helped you fundraise now or in the past?
Yeah, I've said it, but just having a long-term approach and being extremely genuine on what you're about, who you are, what you're doing, um, and just being thoughtful, it's huge. Like, that just goes without saying. I think a tactic for me, whether it's related to fundraising, but it's also just like, I think in life is, you and I have done this actually. It's also like, when you meet people that you really click with and you think are awesome and genuine, and you have that alignment not only in business but just in how you approach your craft, your friends, or relationships, like, who are their people if they're a newer friend? Like, who are the three people that they love spending time with, and meeting those people, regardless of if it's directly for the fundraise or if they're at your stage or whatever it is. Like, so much good has come out of that for me, of just no agenda. No, like, obviously, yes, people are busy, you have your time, you're building a business, but like, being thoughtful around it, but meeting those great people that people you think are great love, is so invaluable. And like, I think a lot of people in a fundraise think, I got to canvas the universe, I got to know everybody. And it's a bunch of like very shallow relationships, and it turns into like a game of FOMO and all this stuff. Whereas like the founders who have deep and narrow relationships with certain investors, or a universe of investors that they've really just spend a lot of time with over a long period, I think have the best types of fundraisers, versus the ones that are like canvassing and trying to create FOMO around like one or two meetings, let me know in a week. I don't think that is going to be very favorable in a market like this anymore. Um, so it's meeting the right people and then doubling down on that and then meeting their people and doing the same thing. And over a long time, that compounds. So whether it's meeting other investors they like, if you're in a fundraise, or whether it's in a sales process, meeting great partners of theirs or meeting great clients or whatever it is, and just providing more value than anyone could ever provide to you without expecting anything in return is like a formula for me that has continued to be important and worked.
That's the best formula of life. If you take away anything from this pod, that's it. That's the formula. And I kind of look at it as like a tree almost. You know, it's like, you know, your the core of the trunk of the tree is like your values and what you care about. And naturally you'll find people that have that, and then that'll take you down this like other branch. And that branch will have all these different, you know, leaves to explore and different people. And if you try and, you know, just jump from like tree to tree and they're not your people, they don't see the world the same way as you, and you know, it's more shallow, it's tough. So I just think of like kind of expand that tree over time.
I like that. I haven't heard that one. Yeah, that's good.
Something like that. I don't know. Anyway, man, how can people get in touch with you if they want to just, you know, catch up, or they're learning more about venture debt? LinkedIn best place? Or
I'm on kind of everything at this point outside of LinkedIn and email. So yeah, LinkedIn and Dolik at TriplePoint.com, TriplePoint Capital. Um, you know, through friends. I'm generally out there and want to meet great people who are in it for genuine reasons. And I just kind of stay under the radar on the social stuff and all that good stuff outside of, you know, the LinkedIn, which is an easy one.
sweet, man. Well, I'm glad we pulled you onto the radar for this podcast, man. This was super fun. Appreciate you doing this, and just again appreciate your partnership. Excited to work together for the next decade plus, man. We got a lot of good years together. So appreciate you, man. And for all our listeners, you know, I always say it, listening's one thing, executing something totally different. So hopefully some of the things we talked about today will help you, you know, close your next round, help you with fundraising, help you with relationship selling. And we'll see you all next week.